Have you ever just stopped and wondered if the way we've all been taught to handle our pensions is, well, maybe just a little bit broken? Today we're diving into what's being called a quiet revolution in investing. It's a data-first approach that's throwing a serious challenge to the old-school, sometimes romantic world of the star fund manager.
But, before we even get into the numbers and the charts, let's talk about what's really at stake here. Your pension. It's not just a pile of money, is it? It's supposed to be a promise. The promise of freedom, of dignity when you finally decide to retire. And how that promise gets managed? Well, that can make all the difference between a future you're excited for and one you're worried about.
So, we basically have two competing ideas. On one side, you've got the traditional guardians of our money, the fund managers we've been told to trust for years. And on the other, you have this modern alternative, the Evidence-Based Great Investments Program, or GIP for short. We're going to really break down how these two stack up.
For generations, really, the British middle class has kind of outsourced its future. We've handed over that pension promise to professional fund managers. And the logic seems sound, right? These are the experts, they have the resources, they're supposed to get better results. It just felt like the responsible thing to do.
But, and this is a big but, this is where that comfortable story we've all been told starts to fall apart. Once you peel back all the fancy marketing and just look at the cold, hard data, a very, very different picture starts to emerge. Okay, so let's get into it. This is where we deconstruct the biggest promise of the entire fund management industry, this myth of the star manager, and we see how it holds up against the unforgiving reality of math. Just look at that number, 90%. Now, according to the S&P SPIVA scorecard, which is basically the industry's official report card, that's the percentage of global stock funds that failed to beat their own benchmark over 10 years. I mean, just let that sink in. 9 out of 10 professionals didn't even match the market. They are paid very, very well to outperform.
And fees, oh man, fees are a monster in this story. Look at this chart. Your gross return might be 100%, but after the fees are scraped off the top, what you actually get can be way, way less. A tiny-sounding annual fee, maybe 1 or 2%, doesn't seem like a big deal, but over 25 years, that can literally eat up to 40% of your potential capital. That's the difference between retiring on your terms and having to work for years longer.
And that is why this phrase just nails it. The traditional model is often a triumph of marketing over mathematics. You're sold this exciting story of a genius manager, but the math often shows you're just getting what the market gave, minus their pretty significant cut.
So what's the alternative then? Well, the GIP approach swaps that story for data. It's like an algorithm of reason. Every single decision is based on proven, empirical factors, not a manager's personality or gut feeling. So instead of guesswork, it's looking at measurable things, like a company's quality, its valuation, its volatility. It's about a process you can repeat, not a person you have to believe in. Okay, let's shift gears to the next big point of difference, transparency. This is all about being kept behind a curtain versus being handed a clear, easy-to-read dashboard.
Think of the traditional fund as a kind of black box. Yeah, you might get a super complex report once a quarter, packed with jargon, but do you really know what you own? Do you understand the risks being taken with your life savings? That kind of complexity, honestly, it usually benefits the seller, not the buyer. The GIP model, on the other hand, is built on what they call radical transparency. Every single stock you own is disclosed. The reason for owning it is explained. It brings back that crucial link between owning something and actually understanding it. You can see for yourself exactly what's going on.
And there's a powerful psychological reason for this. As the Nobel laureate Daniel Kahneman said, transparency and accountability are the enemies of overconfidence. By making everything totally clear, the system keeps decisions grounded in evidence, protecting you from one single manager's hunches and biases.
So let's follow the money now. Let's look at the actual business models. Because this all comes down to incentives, right? Who is each system really designed to serve? Is it about making you dependent or building a real partnership? To get this, you have to understand one key acronym, AUM, Assets Under Management. In the traditional world, managers get paid a percentage of the total pot of money they're handling. So their main financial incentive isn't necessarily to make your money grow, it's to gather as much of everyone's money as possible.
And you can see how that one little detail leads to two completely different goals. The old model focuses on accumulating your assets and creating dependency, making you feel like you need them. The GIP goal is totally different. It's about delivering what they call compounding intelligence, giving you the knowledge and the tools to become a smarter, more empowered investor yourself.
So, in a nutshell, the GIP philosophy is about earning your trust by actually empowering you. It's a system designed to succeed when you become more confident and competent, not one that profits from you staying in the dark.
All right, let's bring this all home. As you can probably tell by now, the final verdict isn't just about which product has better returns. It's a much deeper choice about how you want to approach your own future.
And what's so compelling is that this GIP system isn't just some newfangled idea someone cooked up. It's built on a solid foundation of decades of Nobel Prize-winning research from giants in the field, people like Fama, French, Thaler, and Kahneman. This table, I think, just lays out the choice perfectly. Is your foundation going to be built on faith in some manager's mysterious skill or a belief in cold, hard data? Are you buying a product that sells you comfort and a good story, or one that actually builds your competence and works with probabilities? It's a totally different worldview. It really reminds me of that classic Warren Buffett line. It's better to be approximately right than precisely wrong. The GIP model isn't trying to hit a home run every single time. That's impossible. It's designed to get you consistently, transparently, and purposefully approximately right. And when you take a step back, you realize this isn't just about choosing a better investment product. This is a quiet revolution. It's about a fundamental shift in who holds the power, who gets the information, and ultimately, who controls the future for UK savers.
And that brings us to the final and maybe the most important question of all. The choice between these two models really just boils down to this. Who should control your future? An industry that's often built on complexity and faith, or you, armed with data, transparency, and control?